The bear flag is one of the most traded continuation patterns in the markets, but most traders lose money on it, and it's not because the pattern doesn't work, but because they misunderstand structure and enter too early. Today I'll show you how to trade the bear flag properly using structure, liquidity, and logical risk positioning. Let's start with the core framework. A bear flag always begins with an impulse leg down. This impulse leg is a strong, aggressive sell-off that breaks structure and creates imbalance in the markets. That move is what we call the flagpole. After this expansion, price becomes stretched in the short term. Sellers begin taking profits and buyers attempt to buy the dip. Instead of reversing, price starts to consolidate. If that consolidation forms tight, upward sloping channel, a bear flag may be developing. Structurally, we draw two parallel trend lines, one connecting the higher lows and the other connecting the higher highs. Price moves between these boundaries in a slow, corrective manner, often retracing somewhere around the midpoints of the initial impulse. Eventually, the corrective bounce begins to weaken. The continuation move starts when price decisively breaks below the lower boundary of the channel, ideally with a strong close outside the structure rather than just a wick. That close confirms sellers have regained control. As for the target of the next impulsive leg, it often follows the measured move principle. We measure the height of the flagpole and projects that same distance downward from the breakdown points. Markets tend to move in expansions of similar magnitude, and this projection often aligns with the next major support area. Now, while every bear flag follows this core structure, expansion, correction, continuation, the way each setup develops can vary. So next, we'll look at several real case studies to break down the different bear flag variations and how to trade each one with logical risk to reward ratio. Alright, so the first setup we're going to analyze is the bear flag combined with a fair value gap. On this chart, the overall structure is clearly bearish. As price continues to form lower highs and lower lows, that tells us sellers are in control. We first identified the flagpole, a clean, strong sell-off from this swing high down to this reaction low. After that impulse, price forms an ascending channel. The move upward is controlled, overlapping, and lacks the same aggression as the initial drop. Now here's the key detail. The highest point inside the channel aligns with the bearish fair value gap created during the initial sell-off. That means the pullback is retracing into an imbalance zone where sellers were previously dominant. A bear flag alone can work, but when the retracement aligns with fair value gap, we now have confluence, structure plus location. One common beginner mistake is measuring the flagpole from the absolute top of the charts. A proper flagpole begins from one clean expansion leg with minimal pullback. If the move from the top is choppy, that entire section is not part of the pole. The pole starts at the last structural high that directly leads into the displacements. Once the correct flagpole is identified, we measure its height and project it from the breakdown points to estimate a logical continuation targets. If you're finding this helpful so far, hit the like button and subscribe. It helps us continue producing free, structured trading educations like this. Moving on to the second example. Again, we identify the flagpole, a strong, clean sell-off that sets the bearish direction. Price then forms an ascending channel, representing the corrective phase. Inside this channel, buyers attempt to push price higher. However, price gets rejected at a level that aligns with both bearish fair value gap and a previous support turns resistance zone. That's stacked confluence. When multiple resistance factors align at the same level, the probability of rejection increases significantly. Some traders may enter short directly at that resistance zone, with invalidation above the neckline. Other traders may wait for confirmation, which is a break below the lower boundary of the channel, followed by a retest plus rejection of the broken structure. So if you were to enter here, the invalidation would be above the highest points of the flag. Both approaches follow the same logic. Trade with the dominant strand and use confluence to increase probability. Now in this example, something different happens. Price briefly trades above the immediate origin of the flagpole. At first glance, some traders might think the pattern is invalid. But here's what matters. Price does not break and close above the previous major swing high. Instead, it performs liquidity sweep at the previous swing high level and then gets rejected. There is no true structural shift. The overall lower high, lower low sequence remains intact, and this is where many beginners get trapped. They short too early inside the channel and place their stop just above the local pivots. When price sweeps that level, they get stopped out before the real move happens. Once again, the safer approach is to wait for confirmation. The higher probability entry comes after a price breaks below the channel and then retested as resistance. That breakdown and rejection confirm that sellers have regained control, and if you had entered here, you would have gotten a nice short setup with invalidation just above the previous swing high area. And that wraps up this breakdown of the bear flag pattern. If you found this video helpful, check out my other videos where I go deeper into continuation patterns, liquidity concepts, and risk management. The more you understand structure, the sharper your execution becomes. Make sure to subscribe and turn on notifications so you don't miss the next breakdown. I'll see you in the next one.